Toni Sacconaghi, he's the senior analyst at Bernstein today. He upgraded the stock. He raised his price target. Oh, wait a minute. He did neither. Tony, were you unimpressed?
The quarter was very strong. I think as everyone has alluded to, expectations were high. I mean, this is a stock whose multiple has gone up, 80+% over the last 12 months. And so that reflects heightened expectations. And I think in speaking with investors today, part of the reason for the perhaps muted response is the beat was all iPhone. In fact, they beat by $3 billion. I think iPhone beat expectations by $4 billion. And, there are some folks who are just saying, look, this story is about wearables and services, and those didn't beat. And expectations, we're expecting that they would at least meet or beat. And folks are saying, look, I'm not sure I'm going to pay for a cyclical pop in iPhones. Yes, iPhones were much stronger than expected. We think units grew 13%, but let's not forget they were down 16% last year. So iPhones are still lower than they were 2 years ago, which wasn't even a peak cycle for Apple. And so I think that is that is sort of the mitigating factor. Typically when numbers go up, especially revenues, the stock works well. We're seeing that, but we're maybe not seeing it to the degree given the source of the beat.
I get you. I guess I have a hard time reconciling the narrative, though, in the bigger picture. It's sort of the negative case on Apple over the past couple of years is, iPhone sales are slowing. It's no longer about the iPhone. Yes, it's the most important product that they make, but it's all about services and wearables. So that's the negative. That's why you could, I guess some people could have a negative view on the stock. Now that the iPhone actually beats expectations, it's like, well, the beat was all iPhone. Now we're hanging on the fact that the wearables and the services were not so great, even though the numbers are big. I don't get it.
Well, I think two things. One, there is a question that if iPhone is really strong this year, might it take away from next year? And I think that's a very legitimate question, which no one has the answer to, because it's a function of ultimately how carriers market 5G phones, what the price point is, what the feature functionality is of the phones. But intuitively, what happened last year was basically no one bought the iPhone. It wasn't a compelling product cycle, and iPhone units were down in the teens last year. And so this year, there were a lot more people with older phones, cracked screens, batteries wearing out. There were a lot more eligible upgraders, and we're seeing those people upgrade to some degree this year. The question is, if we have a big cohort of those people upgrading this year, will there be fewer to upgrade next year than we had thought 24 hours ago? And that's also a legitimate question.
Maybe so, but they've up their installed base to 1.5 billion. You've got 5G coming. Wearables knocked it out of the park. Doesn't that mitigate any of the bigger picture issues that you've had your arms wrapped around for the last couple of years as the stock has just run away, especially over the last 12 months?
Again, Scott, relative to expectations, right? A stock that's doubled in the last 12 months. The services and wearable story have been intact for the last 12 months. Everyone has known about that. And so the question is, what was incremental on the earnings release? It was that iPhone was stronger. Okay, well, maybe it was stronger in 2020, but everyone is playing this for 2021. So if 2021, which is the number that everyone is putting a 20 multiple on, is, if anything, marginally, you may be more conservative now about 21 because you're getting it in 20. I don't know why it's off to the races from here after the stock's doubled.
I mean, it's easy to say that after you missed all of 2019, though. I hear you. After you sprint the way you did, I'm talking about the stock, not you personally, You sprint the way you did over the last 12 months, of course things have to cool off. It's easier for you to say at this point, well, how much more upside is there really after the stock was up 111%? What would it take for you to upgrade your opinion on this thing from a market perform, as almost everybody else at this point? And I'm not asking you to just join the crowd for joining the crowd's sake, but what would it take for you to get off of that market perform rating?
Well, look, I think as Amy said, that the time to buy stocks, which I think are more cyclical rather than sort of growth stocks that are going to perennially grow at 10% plus per year, is when sentiment is lower and valuation is lower. And so we would look for one or two things, and we've been pretty transparent about that. One, we would look for a better entry price, because we now have Apple at its highest valuation levels since 2011, when the company was growing at 50% a year. Or secondly, we would like to see the transactional hardware model, which is still 70% of revenues and close to that in profits, so that's iPhone, iPad, and wearables. We'd like to see that transactional model be more of a service or subscription model. Then you really have a company that is a subscription-based company that deserves a dramatically higher multiple, and one arguably higher than it is today. And so those are really the two things.
You think the multiple's gotten ahead of itself 24 times forward?
You know, the multiple is very rich. I mean, look, I would have said the same thing $50 ago, and so I'm hesitant to say it now. By any metric, the multiple is very rich. It's off the charts relative to its 5-year history, which is when Apple has had more modest growth. And as I mentioned, it's trading at the same multiple when it was growing 50% a year. I mean, those are suggesting the multiple is rich, and sentiment is pretty enthusiastic.
How should investors in the stock, everybody on our desk today, just for starters, and those watching, what about buybacks? You know, Apple buys back a lot of stock. The stock is obviously elevated a lot. How does that factor into what Apple's going to do going forward, and what that could mean to a further appreciation of the stock price?
Well, Apple's been very consistently buying back its shares, about $20 billion worth per quarter. Again, all these numbers are perverse given the size of Apple. So they're buying back about $20 billion worth of stock per quarter. So on a $1 billion market cap, if you buy back 80 billion, that lowers the share count by 8%. That raises earnings by 8%. Now, if you still buy back 20 billion a quarter and your market cap is now 1.4 billion, you're buying back more like 5.5%, so your share count goes down 5.5%. So the contribution from buybacks, given a relatively consistent level from Apple, is more muted. And we think the buyback level can continue for about another 2.5 years, given Apple's cash flow dynamics. And then at that point, the company will be cash neutral. So it's still a significant driver of earnings. It's just more modest given how much the stock has gone up over the last year.
And that doesn't factor into your view on either the share price or the share rating?
Not really, Scott. I mean, again, that was all in our models. I think if when I adjusted my model last night, what we found was we had been modeling Apple buying back 320 million shares per year. We had to take that number down to about 250 for next year, so less of an impact, simply because the stock has gone up. So again, all else being equal, it's less of a factor. It's still a great factor. It was just in mine and everyone's models beforehand.